He was called the next Warren Buffett. His company was worth $32 billion. Then, in 1 week, it all came apart, and $8 billion of customer money was gone. This is how it happened. In 2014, Sam Bankman-Fried graduated from MIT with a degree in physics and a minor in mathematics, heading straight to the quantitative trading firm Jane Street. By October 2017, he struck out on his own, founding Alameda Research. Alameda was a trading firm, an entity designed to use its own capital to make speculative bets on market movements. Its early success relied on arbitrage, specifically exploiting the kimchi premium, where Bitcoin sold for higher prices on South Korean exchanges than in the United States. Arbitrage is simply buying an asset in one market and instantly selling it in another to pocket the price difference. In 2019, Bankman-Fried expanded his footprint by launching FTX, a customer-facing cryptocurrency exchange. Unlike a trading firm, an exchange is built to provide custody, safekeeping customer assets while matching transactions between buyers and sellers without taking a directional bet on the market. Although Alameda and FTX were established as legally separate entities, they operated with common leadership, shared technology, and overlapping offices. This structural crossover created a fundamental tension. A single founder oversaw both a private trading house and the public warehouse holding client funds. By 2021, FTX was rapidly moving from a specialized crypto platform into a mainstream consumer brand. SBF committed $135 million to rename the Miami Heat's home court the FTX Arena, plastering his logo across national television. Next came a multi-million-dollar Super Bowl commercial starring Larry David, backed by endorsements from Tom Brady, Gisele Bündchen, and Stephen Curry. In January 2022, a Series C funding round raised $400 million, launching the company to a peak valuation of $32 billion. In business, valuation is not cash in a vault. It is a calculation of perceived future worth, highly sensitive to market sentiment. SBF used this paper wealth to buy influence, donating over $100 million to political campaigns and securing media profiles that compared him to a young Warren Buffett. He was hailed as a financial prodigy, a billionaire who slept on a beanbag, but this massive public profile served as a substitute for real oversight. The market accepted high-profile visibility as a proxy for financial verification. Venture capital firms like Sequoia Capital, SoftBank, and Temasek poured hundreds of millions of dollars into FTX, offering institutional validation that retail investors took as a stamp of safety. Bankman-Fried reinforced this corporate credibility with a calculated moral framework. He championed effective altruism, promising to acquire massive wealth solely to fund high-impact philanthropic causes, making him appear distinct from conventional speculative promoters. His media presence grew through constant public appearances and high-profile interviews. On December 8, 2021, Bankman-Fried testified before the House Financial Services Committee, presenting himself as a cooperative regulatory partner. He publicly claimed that FTX was a resilient, risk-reducing platform designed with customer asset protection at its core. His casual attire, modest personal presentation, and technical fluency created a powerful illusion of transparency. Elite investors and everyday users alike accepted this coherent trust narrative, mistaking polished advocacy and altruistic promises for independently verified financial safeguards. But behind this wall of reputation, the actual mechanisms of control were virtually non-existent. The core rule of any financial exchange is custodial segregation. Client funds must remain isolated from the platform's operating capital. Unlike a bank, an exchange is not supposed to lend customer deposits to generate yield. It must hold them in trust. But at FTX, this division was compromised from the start. Operating alongside the exchange was Alameda Research, a proprietary trading firm designed to make speculative market bets. While FTX was responsible for safeguarding customer assets, Alameda's incentive was to take massive risks. Because both entities shared common leadership, the operational boundaries between them quickly dissolved. This entanglement was compounded by an absence of corporate governance. For years, FTX operated without an independent board of directors and without a chief financial officer. These were not minor omissions. They were fundamental control failures. Without an independent board, there was no body to challenge Bankman-Fried's decisions, audit the flows of cash, or enforce risk parameters. Without a chief financial officer, the multi-billion-dollar enterprise lacked a single senior executive accountable for financial reporting or client capital preservation. Instead, a tiny group of insiders controlled all financial and engineering decisions. At the center of this system were three figures operating directly under Bankman-Fried: Caroline Ellison, who managed trading at Alameda; Gary Wang, the chief technology officer who wrote the exchange's core code; and Nishad Singh, the head of engineering. Behind the scenes, the code was configured to grant Alameda extraordinary privileges. Standard exchanges employ automated liquidation protocols to instantly close out a user's position if their losses exceed their collateral. But FTX's database exempted Alameda from these checks, granting the firm an unlimited line of credit funded by customer deposits. This allowed Alameda to trade with massive borrowed exposure, a mechanism that magnifies losses when market risk limits are inadequate. The system operated on an existential contradiction: an exchange trusted to protect assets and an affiliated trader holding a master key to the vault. On November 2, 2022, CoinDesk journalist Ian Allison published an investigative report that exposed Alameda Research's private balance sheet. The document revealed that Alameda held $14.6 billion in assets. But the foundation of this wealth was highly circular. Approximately $3.66 billion of the portfolio was held in unlocked FTT, a utility token created and issued by its own affiliate, FTX. Another $2.16 billion consisted of FTT pledged as collateral. In total, over $5 billion of Alameda's assets were tied directly to the token of its sister exchange. This was not a standard case of holding a volatile but independent asset. FTT had no broad, independent market. Its quoted price was highly sensitive because there were very few active buyers outside of FTX itself. If Alameda ever needed to sell its FTT to raise immediate cash, the sheer volume of its holdings would instantly overwhelm the market, crushing the token's price. The report transformed a private accounting detail into a public test of confidence. It exposed a structural loop. The apparent strength of the trading firm depended entirely on a token printed by the exchange it was supposed to be protecting. At 10:47 a.m. UTC, on Sunday, November 6, 2022, Binance Chief Executive Officer Changpeng Zhao announced on social media that his exchange would liquidate its entire holding of FTT, worth roughly $580 million. The announcement transformed market doubt into immediate panic, triggering a classic bank run. A bank run relies on a simple, self-fulfilling mechanism. Depositors prioritize exiting an institution before its condition worsens. In traditional finance, there is a fundamental distinction between solvency and liquidity. An exchange might possess billions of dollars of assets on its books, but if those paper assets are tied up in illiquid, unsellable tokens, they cannot be accessed immediately. Over the next 72 hours, customer anxiety translated into physical flight. Users flooded the platform with withdrawal requests, attempting to pull $6 billion from the exchange, a volume representing 37% of all FTX customer deposits. This massive drain completely exhausted the firm's liquid cash reserves. On November 7th, Sam Bankman-Fried attempted to stop the panic, posting a public reassurance: FTX is fine. Assets are fine. It was a direct promise of safety, yet the underlying balance sheet immediately contradicted his words. By November 8th, FTX suspended all customer withdrawals, locking users out of their accounts. The freeze did not create the underlying deficit, but it laid it bare to the public. With the confidence narrative shattered and the vault empty, the exchange was forced to seek an immediate outside rescue. On November 8th, Binance Chief Executive Changpeng Zhao threw a temporary lifeline, announcing a non-binding letter of intent to acquire FTX's non-US business. It was a potential bailout, but it depended entirely on corporate due diligence. The next morning, Binance's team examined FTX's internal books, discovering a chaotic mix of liabilities, customer obligations, and massive liquidity exposure. Within 24 hours, the rescue collapsed. On November 9th, Binance formally withdrew from the proposal, citing mishandled customer funds and reported regulatory investigations. In a public statement, Binance declared the problems were beyond their control or ability to help. The aborted deal eliminated the last viable path to survival, stripping away any remaining market confidence and leaving Bankman-Fried with an empty vault and no remaining options. On November 11, 2022, Sam Bankman-Fried resigned, and FTX, Alameda Research, and more than 100 affiliated entities filed for Chapter 11 bankruptcy protection in Delaware. The court appointed John Ray III, the veteran restructuring expert who had overseen the liquidation of Enron, to manage the wreckage. Ray quickly discovered an organization operating with an unprecedented lack of record-keeping, relying on informal chat applications and simple spreadsheets to track billions of dollars in transactions. Initial reviews identified a customer funds gap of approximately $7.7 billion, a figure widely reported as an $8 billion hole. In a corporate bankruptcy, this gap represents the discrepancy between total customer claims and the liquid assets actually available. It is not a single missing pile of currency, but rather a tangled combination of trading losses, illiquid investments, and real estate purchases. Forensic tracking began mapping these outflows. Approximately $4 to $5 billion had vanished directly into Alameda's speculative trading losses. Another $1 billion was tied up in venture capital investments, including a 7.84% stake in the artificial intelligence startup Anthropic. More than $250 million was spent on luxury properties in the Bahamas, while roughly $1 billion was distributed to executives as personal loans, and over $100 million went to political campaigns. The filing changed the situation from a liquidity emergency to a legal reconstruction. The public accounts of how these funds vanished would soon face rigorous testing in federal court, where prosecutors prepared to present their evidence of fraud. On October 3, 2023, the federal trial of Sam Bankman-Fried opened in the Southern District of New York, shifting the focus from corporate bankruptcy to criminal accountability. Over 5 weeks, prosecutors dismantled the defense by calling Bankman-Fried's closest associates to the stand. Carolyn Ellison testified that she repeatedly altered Alameda's balance sheets and diverted customer deposits to cover the trading firm's liabilities, acting under Bankman-Fried's direct instructions. Gary Wang detailed the specific database privileges he programmed into FTX, verifying the secret backdoor that gave Alameda unrestricted access to user assets. Nishad Singh completed the insider picture, testifying that over $100 million in political campaign donations and executive bonuses were pulled directly from the customer pool. The defense presented Bankman-Fried as an overwhelmed math graduate who acted in good faith, relied on legal counsel, and was ultimately caught in a broader market collapse. Bankman-Fried took the stand himself, maintaining that his actions lacked fraudulent intent. The jury rejected this explanation, delivering a unanimous guilty verdict on all 7 counts of wire fraud, securities fraud, and conspiracy on November 2, 2023. In March of 2024, Judge Lewis Kaplan sentenced Bankman-Fried to 25 years in federal prison and ordered an $11 billion forfeiture, declaring the scheme an egregious fraud of epic proportions. The collapse of FTX offers a stark lesson. Marketing, personal charisma, and high valuations are poor substitutes for audited books, independent boards, and corporate governance. For investors and builders alike, the ultimate safeguard remains transparency and verifiable controls. This is exactly the kind of decision-making smart money is built to help you avoid: data over hype, discipline over excitement. Protecting capital requires moving past the theater of corporate prestige and asking hard, structural questions. First, who legally holds the assets, and are those deposits strictly isolated from proprietary trading? Second, do separate business entities operate with genuine independence, or are they exposed to related party conflicts? Third, is there an independent board of directors, a qualified financial leader, and documented risk limits to constrain executive decisions? True safety depends on objective verification rather than blind trust. Investors must examine whether financial statements are independently audited, current, and backed by reliable records. They must evaluate concentration risks, particularly if a platform issues, promotes, and relies on its own self-issued asset as collateral. Credibility cannot be inherited from crowd validation, high valuations, or brand visibility. It must be tested through direct proof of reserves, clear liabilities, and verified withdrawal access. The ultimate defense is always systematic, independent verification. Rapid growth does not justify delaying internal controls. It makes them immediate requirements. For any building enterprise, scale demands an independent board with the authority to challenge a founder before a crisis occurs. Safe expansion relies on clear ownership of finance, treasury, and risk, overseen by accountable senior financial leadership. Customer assets must remain isolated within separate systems, protected by documented permissions and written approvals for related party transactions, borrowing, or risk limit adjustments. Outside reviewers must be able to verify these operations through clear, audit-ready records without relying on private spreadsheets, personal memory, or exclusive founder access. Rigorous internal controls are never obstacles to progress. They are the baseline protections enabling sustainable speed. Ambition fails when it moves faster than verification. This is exactly the kind of decision-making smart money is built to help you avoid: data over hype, discipline over excitement. The courtrooms are silent, and a 25-year sentence is locked in, yet the $8 billion void remains a permanent warning. In a market still chasing the next savior, the temptation to value charisma over compliance never truly fades. This is exactly the kind of decision-making smart money is built to help you avoid: data over hype, discipline over excitement.